Hello and a warm welcome to Talking Stocks. I'm Gugulethu Cele. In studio with me, I'm joined by Ashton and David Gibb, both from Anchor Capital. Now today we're talking US Bancorp, an American diversified financial services holding company. The bank offers regional consumers and business banking and wealth management services, national wholesale as well as trust services and global payment services to cover 15.8 million customers. The company also employs well over 65,000 people. Geesh, David, sounds like this is a juggernaut of a banking company, but if we delve into the operations further, it seems as though it's a little bit of everything.
Yes, it's got a very nicely diversified portfolio. And I think what makes it unusual when you look at the other big banks in the US, and I'll touch on the relative size of the bank, is that it's got quite a big payments arm. So payments represents about 25% of the revenues, and that traditionally is a very profitable area. So that's the one thing that distinguishes them. The other thing is that they don't really have a big investment banking business. So you would argue that it doesn't have a highly risky segment within its portfolio.
On the payments arm, does that mean that a lot of revenues derive then from the fees and transactional costs that might
Correct.
be involved?
So that's on the non-interest element. And so a lot of that will relate to credit cards, usage of credit cards, not only from their own customers, but from merchants who connect via US Bancorp. So that's a very good business, and they've got quite a decent market share in the payments business. As
we see on the slides, the fifth largest American bank by assets too. But is this a company that has also been under pressure, especially following the 2008-2009 crisis, Sean?
I think along with the rest of the sector, they've naturally felt the pressure on net interest margins. But when you look at their return profile relative to a lot of other banks, they're actually still operating at quite decent levels. So they get a return on equity of early to mid-teens at the moment. And I think what attracted us to this business at the outset is that fairly uniquely within the US banking space, it was one of the few banks that actually, following a number of acquisitions that they've done, they've actually integrated all of their systems and consolidated their systems into one kind of global system. So whether it be mortgages or something else, they're operating off one operating system. They don't have legacy systems across a whole lot of different subsidiaries that they operate. So naturally, it's a more efficient bank than many of their peers, and that's reflected in the types of return on assets they get and the return on equity that they can achieve.
If we stick to that theme regarding efficiency, extreme efficiency, the return on average assets as well seems as though it did take a bit of a peak in 2012, 2013, David?
Yes, so obviously they came through the financial crisis very well, and they were seen as a sort of a high quality bank. So there was a flight to quality. They picked up a lot of assets. Their returns were good, but I think the interest situation. So the net interest margin has still been trending down for a while. So that would have pulled down their ROE slightly. So from the 2012 level, but it's still around 15% for last year. And that makes it very unusual. So their cost to income ratio is about 53%. And that would be the lowest of any of the big banks in the US. So when you look at most of the measures that generally come first on, as top performing in most areas. And the beauty too is that because their assets are about $400 billion now, even though they're a big bank, they're much smaller than a bank like JP Morgan, which has more than $2 trillion in assets. So you could see then the potential to grow market share over the years is phenomenal.
How sustainable is that? Because I see 34% of the portfolio consists of consumer as well as small business banking. We know about the pressures in the US economy and that it's looking to go on an upward trajectory. But does that weigh heavy on your mind, maybe when you analyze this particular company and the growth prospects going forward?
Not for me at all. So I think they can gain market share. They can grow their assets to 500 billion, to 600 billion, to 700 billion, even up to 800 billion.
Organically?
Organically. They might pick up little portfolios along the way, but you'll notice now that we haven't seen a lot of merger activity in the banking space in the US. I think after the financial crisis, most banks reined in. They also wanted to get their capital ratios right. And the regulators haven't been keen on, big banks doing mergers. So they're picking up little portfolios from whatever assets are for sale. So, they are seen as a super regional bank which means that they are bigger than just a regional bank. They're in about 25 states in the US, so they can spread geographically. I mean, historically they've been in the Midwest and the western part of the US, and that's really a reflection of the mergers that were done over the years. In fact, what's interesting is US Bancorp is the result of two big mergers in 2001 between First Star and US Bancorp. And these two banks were run by brothers, funnily enough, Jerry and Jack Grinthofer. And the youngest brother took over as the CEO when these two banks merged. So there you can sense probably maybe had a similar culture, those two banks anyway, being
You're
run
right.
by brothers. And that's maybe why it's also quite a unique bank in that there's this special culture on efficiency and the way things are run.
Sounds like there's a cure for sibling rivalry then, all around. Merge your companies together. But if we take a look at the scale of the company versus other companies we've profiled on the show, Amex as well as JP Morgan, wouldn't those bigger firms look slightly more attractive then, given their scale and reach?
Well, not necessarily. They don't really have the potential necessarily to gain as much market share. And I think that's what's nice about this business, is that it's going well anyway. So they can improve their efficiency slightly, but the big thing is they can just gain market share. And that's, whereas a JP Morgan is not necessarily growing its book as quickly as US Bancorp could. JP Morgan can maybe run itself a little bit more efficiently. So there is scope for big improvements in JP Morgan, and we think it's one of the best run banks in the world under Jamie Dimon. But I think US Bancorp, it can just grow slowly. It doesn't have to take on a lot of risk by making any big acquisitions.
And I think to add to that, I mean, what we've previously said about the US banking industry is that big does pay. In other words, if you're a big player, you have the ability to deal with all the regulatory costs that come with the new environment that we find ourselves in. So you tend to find that the big get bigger and the small tend to fall by the wayside. But when we're talking about smaller banks, we're really referring to the regional banks that can't necessarily cope with the regulatory burden. So US Bancorp wouldn't be the biggest necessarily. I still think that the big get bigger, but US Bancorp within that probably has the ability to gain market share out of most of them. But still, if you're a JP Morgan or a Wells Fargo, I think you're better placed than if you're a pure regional bank.
Exactly. So we're talking about a growth prospect
Yes.
going forward. If we look at the next two upcoming graphs that look at net interest margins, which do seem to have taken a bit of a dip, as you mentioned, at multi-decade lows, and even the price to book values, how do those compare, and what's the competitive edge here for US Bancorp?
I think we could say that the banking sector for investors in the US is slightly out of favor. Net interest margins are low. Now, we were anticipating net interest rates to pick up in the US this year. It might not happen. It might be delayed somewhat. But I think the beauty of a business like a US Bancorp is that they are very efficient and they will know how to cut costs even further. So in an environment where net interest margins possibly stay lower for longer, they can still make the most of that by cutting costs further. And keeping their ROEs quite high. But it is one of those things where you could own this bank for the next 10 to 15 years, knowing that at some stage, you don't want to bet against the US economy. Interest rates will go up at some stage, and they will be ideally placed to benefit from that.
If we look at the evaluations of this particular share, how does it compare?
So on a price to book basis, it's trading just under 2 times. So it might be slightly higher than the other banks, the other notable banks in the US, but the ROE is much, much higher anyway. So if you look at it from the PE base, it's about 13 times earnings to December. The dividend yield is about 2.5%. So my assessment of that would be you're paying a fair price for a fantastic bank. Some people often think of it as the ideal bank in the US. It's just got all the right metrics.
Sure. On that note, though, will we need some kind of innovation and competitive edge as well to continue driving the market share growth for this particular company? I think so often we hear about the convergence between telco players and some of the banking and financial institutions.
Yes, we need to keep track of a lot of these fintech companies.
Yeah.
So there's online lending, and there's a lot of innovation now in the payments industry. So that's an area that US Bancorp obviously has to watch out for. There's a lot of innovation in the payments area. But I think the fact that they've been so strong in their systems means that, you know, they tend to actually be quite innovative in those areas anyway. But it is obviously something to look out for. I think the online lending space is not, maybe doesn't have the same outlook maybe as a lot of innovation in the payments area. Online lending in some ways I think will be really tested if we have another downturn. But in the payments area, you know, that's open to debate. And frankly, we're a little bit early in that area to come to any conclusions on a lot of these new payment companies.
Buy, hold or sell US Bancorp. Let's start with you, David.
So I would say this is definitely a buy. In our anchor worldwide flexible fund, this is actually our largest holding. So it's just under 6% of our fund. And I see this as a long-term investment. And I think at current levels, it's attractive.
Probably pick up more in the dips than I take it. Sean, you agree? Buy?
I think timing is uncertain because ultimately a lot of this call relating to the entire banking sector in the States is about where interest rates are going. So the longer that can gets kicked down the road, you know, the more you see relapses in the performance of a lot of these banks. But I agree with Dave. I think, you know, you're paying a fair price for what's a very good asset in the context of very low cost of capital. A 15% return on equity is great. I don't think there's much room for the PE multiple to expand a lot. But at the end of the day, this is a bank that should be able to grow its advances by something of the order of 5% and then get some net interest margin expansion if rates rise longer term. So I think it's a business that can give you double-digit profit growth plus the dividend yield that you're getting now. And there's very little reason to believe that you should have a D-rating in the share from these levels in terms of the PE multiple. So I would expect that it's a business that can give you kind of, you know, 10 to 15% returns in US dollars over time, but with some timing risk. But in the world that we're in, I think that's a good return.
Double-digit growth, exactly. That's something we like. But we'll have to leave it there for today. Thank you so much for your time today and to my guests, both Sean Ashton and David Gibb from Anchor Capital, giving us their views on US Bancorp. Clearly a buy recommendation coming through them. Well, that's where we leave it for this week's edition of Talking Stocks. Do catch us again next time.
For the latest fundamental and technical analysis delivered right to your inbox, log on to talkingstocks.co.za and sign up for the Talking Stocks newsletter.